Welcome back to this week's market update. Today is Monday, April 7th, 2025, and it was a very, very busy week for the market, so we will head right in. All right, jumping right in, as many of you might have known, stocks sold off sharply last week after the announcement of tariffs that were more aggressive than expected, raising concerns about inflation and the potential for a recession. As of close on Friday, April 4th, the S&P 500 closed down 9.1% for the week, mostly due to the drop on Thursday and Friday, as well as the Dow Jones Industrial Average down about 7.9% last week, and the Nasdaq hit the hardest with a lot of tech stocks down big at a 10% loss as of last week. Bonds, on the other hand, posted slight gains as yields fell lower, with the Barclays Aggregate Bond Index up about 0.74% last week. Looking at the market this morning, we can see the S&P 500 was down as much as 4% starting off in the trading session, then with some false reports that the White House was considering a temporary pause on the tariffs. You can see the market reacted up over 6% within the matter of a half an hour or so, up to more than 2% gain for the day, fell sharply as that was reported to be false, and now currently it is about flat on the morning. So a lot of volatility in the market still this week. We expect that to likely continue into this week as there is just a lot of uncertainty about tariffs, about how they're going to be enacted, how long they're going to stay, how it's going to impact corporations, how it's going to impact the US economy, the global economy, a lot of unknowns here. So just wanted to take a quick look at how volatile stocks have been as we start the week. Taking a deeper dive into the tariffs of last week and how they were calculated, it all comes down to this formula here from the US Trade Representative, and it's largely based on the amount of the trade deficit that we have with that country rather than the stated tariff rate that they charge on US imports. So that's really where the big surprise came in. The White House was expected to increase tariffs to a rate more similar to half of what the stated tariff rates are that those countries charge on US imports. Rather, it ended up being more focused on the trade deficit, as we can see in this formula here. So this is the amount of total exports minus total imports over a denominator, which includes elasticity of imports, the pass-through of tariffs to import prices, and total imports. So very complicated way to say that tariffs were not calculated as the market was expecting. They were also a lot more aggressive than what the market was expecting, which led to the sell-off last week. Moving into our more regular economic data from last week, we did get the March jobs report here. It was kind of a mixed bag with some weaker than expected data and some better than expected data. So looking at the unemployment rate, it was a little bit higher than expected at 4.2%. However, the amount of job gains was better than expected at 228,000 new jobs in the month, largely from healthcare, social assistance, and retail trade jobs. In the government sector, federal employment declined by 4,000 jobs in March. However, this figure might understate the impact of recent layoffs, as the survey still counts federal employees who are on paid leave or receiving severance. So this unemployment rate actually might be a little bit understated because all of the federal workers that have been laid off, many of them are on some sort of severance package, which leads to this being a little bit lower than what it would naturally be, as well as the job gains number. So important data to keep an eye on as we see federal workers and the federal workforce change over the coming months. Last but not least, wage growth came in weaker than expected, but was fairly steady at 3.8% year over year. So a little bit above inflation for that average wage growth number. And then we'll take a look at the ISM indexes next. Looking at the ISM indexes from March here, both came in a little bit lower than they were in February, with the manufacturing PMI slipping into contraction and the services PMI falling to a more neutral, still positive, but more neutral level. Within the indexes, we saw things like new orders in manufacturing falling, as well as new export orders with a lot of tariff concerns, employment also falling, and production also falling in the month of March. On the other hand, inventories rose slightly and prices also increased quite a bit month over month. Then looking at the services index, similar trends. We saw employment much lower month over month, new orders lower as well. The backlog of orders has been contracting too. And then new export orders also falling while prices actually fell slightly month over month in the services index. Inventory sentiment up slightly, imports up slightly. So kind of a mixed bag overall, but both indexes did get slightly more bearish from a month ago. Last but not least, taking a look at the current economic indicators. We had a lot of recession concerns last week related to the tariffs and how tariffs might put some pressure on earnings. They might increase inflation. They may lead to some layoffs depending on how they play out and how long they are held at such high levels. Right now, though, economic indicators continue to be fairly solid, actually leaning bullish. You can see here we have 4 bullish indicators, 2 neutral, and 2 bearish, which leads us ultimately to be slightly more bullish than we are bearish. However, I will say many of these operate with a lag. So things like the anxious index, this is only done quarterly. The last one was in early February. Many things have changed in the last 2 months. So we want to take this with a grain of salt because they do operate with a lag. But as of right now, economic data does continue to be fairly solid when we look at what the data actually says. Thank you so much for tuning in. It's been a very turbulent week, but we really appreciate the trust that you put into us every day, and we look forward to providing another update for you next week. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.